Hey everybody, I hope everyone is doing well and had a good day. And in this video, I'm going to review the Emini 5-minute chart for Friday, October 31st, 2025. And I'm going to try to keep the entire chart on the screen for this video and try to go through it fairly quickly. We gapped up going into the day, and if we just look, the past 15-20 bars to the left, we see a tight bear channel and then a really significant trend line break. So what happened here? Surprise bar 79, big bull trend bar closing above several bars to the left, clearly breaking the bear trend line, and then even more follow through, the breakout growing on the gap up going into the day. Remember, the gap up, you can pretty much see the gap as a trend bar. So a bar that opened at the close of 81 and closed at the open of the day. So you can just picture a big bull trend bar, a white bar here. So clearly a huge bull reversal after this tight bear channel. The problem is that usually the market does not reverse from a bear trend into a bull trend. Normally you get some type of major trend reversal pattern, and the ingredients for a major trend reversal are a break of a significant trend line followed by a retest of the trend's extreme, and then maybe you get a major trend reversal. So in this case, we'll take yesterday's low as the trend's extreme. So tight bear channel, gap up, breaking the bear trend line, but expectation is the market is probably in a trading range, and we probably have to come back and test the lows. And how did the open start? The first 7 or so bars. Bear bar 1, bad follow through 2, bear breakout 3, bad follow through, another bear breakout 7, bad follow through. So 3 consecutive sell climaxes with bad follow through. If we think about the micro market structure, that's the market cycle on the lower time frame. We have a spike, implied pullback, another spike, pullback, and channel. And you expect the channel to evolve into a trading range. So spike and channel evolved into a trading range with a reversal up. Because of the sell climaxes on the open, I thought the bears probably are not as in control as they want to be after such a big gap with the reversal on 79 and the sell climax is getting bad follow through, and all of a sudden the selling drying up once we reach support. Yesterday's close, this breakout point, and the moving average. So 3 consecutive sell climaxes to support. All of a sudden we enter a tight trading range. That's breakout mode. There's a small triangle on this smaller time frame here, and there was a failed bear breakout. If you count the legs, it might be like 3 or 4. Maybe it's 1, 2, 3, 4. If you're trading breakouts, you really want to avoid taking late legs. The more it's a trading range, the more you want to count legs, and the more it's a trading range, the more you want to avoid taking late legs. So on the 4th breakout attempt, the market reversed up strongly with growing consecutive bull bars, but we reach near the open of the day and find resistance. So again, think about this implied pullback on bar 2. The high of bar 2 is resistance, breakout, pullback, and then more selling. Traders, and this is all in theory, but this is the way I read a chart and the way it makes sense to me. In theory, there's a bull who bought the high tick of bar 2, and they're very disappointed with their follow through on 3 and more selling on 7. What is that bull going to do if they're given a chance to exit at their original entry price? I think they're probably going to take it. In other words, is a bull going to be eager to buy up here if the market gets back here? Probably not. And you can see the reaction. Maybe a buy vacuum to this price, but then 16 poked above the resistance and then failed to break out. We tried again, failed again. We tried a third time and failed. So this is, even though it's not a traditional shape of wedge, whenever you have 3 pushes in one direction, you can think of it as a wedge. It's also a double top, so wedge, 3 pushes, but also a double top with bar 1 and then strong reversal and follow through 24. Now you're back at the top of the trading range. 23-24 might be a reset of the market cycle, or in other words, a leg 1 breakout. So important for bulls, if they're long anywhere for any reason, even if you bought down here, to exit below, if not 23, probably on the close or below 24. 24 to me is always in short. Breakout pullback, and the breakout grew 26, 27. No technical pullback, so simple leg from 23 down to 27. Finally a pullback, but the first reversal after this much selling probably going to be minor. So as good a signal bar as 27 was, it's after a 4 or 5 bar micro channel. First reversal up, probably going to get sold. You have trapped traders. The bulls who were buying, trapped on the selling. The bears who did not sell, looking to go short. And the result was 3 tight legs down. 1, 2, 3. So 3 legs down, do you fade 34? Some traders will, but after this tight of a channel, you're probably going to get another leg down. So do I think 35 is the low of the day? It might be. Maybe the bulls get a higher high or a higher low, double bottom, and reversal up. But after this tight of a channel, you know, the odds are the first reversal will be minor, and the bears will sell it and get a test of the lows. Also look at the structure of 35 through 37. 3-bar micro channel, yes, but the bodies of the bars are shrinking. And right when you get to the moving average and breakout points, all of a sudden there's no more buying and we have to go lower. Traders are not willing to buy here. They were trapped on the bear breakouts here. And you can see with the momentum of the bars, big bull bar, smaller bar with the tail, even smaller body with a bigger tail. This is a wedge on a smaller time frame. And it's sort of implied. You know, we can take a look. Let's see, 1235 on the 1 minute chart. Just out of curiosity. Strong first leg, maybe tight trading range, second leg, pullback, third leg. So more clear even on a smaller time frame than this. But look at the tight channel. So trendline break, good for the bulls, but still probably need a test of the lows. So as much buying as there is here, it's still probably a minor reversal until there's a test of the lows, and then maybe the bulls get the major trend reversal. And that's happening on the bigger picture too. Tight bear channel, trendline break. Now we have a 3-legged retest of the lows, and it's nested. So big 3 legs, 1, 2, 3, and then in here this structure has 3 legs as well. 1, pullback, 2, pullback, 3. And then look at the market's reaction to yesterday's low. Remember, the bears who sold 78 trapped on 79 and the gap up, they are disappointed by the bull breakout. So what's going to happen if the bears are given a chance to exit at break even? They're probably going to take it, because if you sold 78, maybe you sell for any reason, it's a tight bear channel, you get 79. Let's say in theory, you're using a very wide stop, somewhere far above, maybe even yesterday's high. So your stop is not run, bears are scaling in. What are they going to do if the market gets back to this price? And especially in this structure, this is not a small pullback bear trend. This is uncontrolled sell climaxes into support, followed by a decent rally, another 3 legs down here, and another 3 legs down here in a big 3-legged pattern. So it's basically a wedge double bottom with yesterday's low. Market tried to break out 44, poked below support, reversed up 45, maybe hardly broke below the support, but overlapping the prior bar. 46 actually broke out, needs follow through, doesn't get it. So this is a problem for the bears. We are far below the moving average, and if you're selling this far below the moving average, you need above average bearishness. Instead, you're getting bear bars with bad follow through. Bear bar, but now tails, doji bar 42, big tail, overlap 43, bull reversal bar closing on its high, another leg down, another reversal bar closing on its high. This is not ideal for the bears. If you're selling down here, you have two options. You really need to be careful if you're scaling in, because there's a couple ways to see a late leg here. You've got the big 3 legs down, and you've got these 3 legs down. So as far as selling here and scaling in, I would not. I think if you get a decent reversal bar like 44 or 47, it's probably better to just exit shorts, and bulls they can buy on stops above these bars. If you buy above 44, do you put your stop below 44? No. In reality, this is strong enough selling. It's a maybe 7 bar micro channel down to 44. You can start buying here, but you probably have to buy more below the bar, be willing to scale in, and use a wide stop. This is too strong. First reversal, probably minor. Needs at least a small second leg, and that's exactly what we got. Micro channel, pullback, minor reversal, small second leg. Better trendline break. Breaking this tight channel trendline. Still need a retest of the lows, which we got on 50, and then a stronger reversal up to 53, clearly breaking above this trend line. Compare this 3 bar micro channel to 37 to 51 through 53. Here, the body's clearly getting smaller, tails above bars, and staying completely below the moving average. It's also possibly a reset, this breakout down to 34. It might be leg 2, but it's strong enough selling that you know the first reversal is probably going to be minor and followed by trend resumption, another leg down. Versus over here, the bulls actually got a bar closing above the moving average and a bar completely above the moving average. And now you've got 3 legs down, 1, 2, 3, and it's nested, and you're reversing up from yesterday's low. So here, yesterday's low, still not reached. It's kind of an obvious magnet. Most days test the prior day's high or low. We did not test yesterday's high. Draw that really quick. And here we are approaching yesterday's low with a pretty strong breakout. You know this is probably going to get another leg down, even if it pulls back first. But finally, we get to yesterday's low, and we get this reversal up. And the problem for the bears, it's a little later than a perfect midday reversal, but we're around that time of day where there might be a midday reversal. And if we think about the structure of the day, is today a trend day or is today a trading range day? To me, it looks like the day is a trending trading range day. So a trading range day with trending price action. So it's not a very horizontal trading range day. There are decent swings down, up, and down. But at this point in the day, is it going to be a bear trend day that opens on its high and closes on its low? I'm not sure. Do the bears have enough strength? Are they really in control? And if so, why are we reversing back up at yesterday's low? In a bear trend, all support fails, and the market would just plow straight through it. But that is not what's happening here. Also, big picture, remember, bear trend, trend line break, 3-legged retest, possible lower low, major trend reversal for the bulls. So reasonable for bears to exit on this breakout and reasonable for bulls to look to buy. And then a pretty tight channel up to bar 59. You can call it 3 or 4 legs, so am I correct? But it's too tight to be looking to sell until the bears do something impressive, like break a significant trend line. So it's always in long. Traders will buy the first pullback. Is that enough to sell? Probably not. Maybe it's a trend line break, but it's fairly small. The bars are not impressive. They're not very big. And it's kind of like bar 37. So it's a 3-bar micro channel, but it's approaching the moving average, and it's always in long. So it's the opposite of 37. Always in short, 3-bar micro channel, approaching the moving average. Minor reversal leads to trend resumption. Same thing here. Even though you can count 4, 5 pushes up, on a higher time frame, this is simply 2 or 3 strong bull bars. It's a bull breakout. And the odds are the first reversal attempt down will be minor and be followed by trend resumption, so more to the upside. So not ideal to be selling here. And then the bulls get their second leg. Getting climactic toward the end of the day. Smaller bars, then a bigger bar, even bigger bar. Testing resistance. We had the bar too high drawn. Resistance here, here, and here. So probably resistance here as well. You can see the reaction. Consecutive buy climaxes at the top of the range, far above the moving average, and then a bear bar closing on it well. This is a default exit. If you're long for any reason, it doesn't matter if you bought the low or the high tick of 73. If you get this bar on 74, you just get out of the trade, especially because it's the end of the day. But even if it was not the end of the day, still reasonable to look to exit below 74 if long. It's aggressive to sell, but also not unreasonable to look to sell. And then cross the back below the moving average. So what happened? It's a trading range day. We got 2 legs up to the top of the range, suddenly getting stronger buying at the top of the range, possible buy vacuum testing resistance. And what happens when the bulls lose momentum? They buy the close 73, disappointed 74, unable to exit 75. This is trapped traders giving up, bulls bailing out of their positions, and bears selling, knowing that it's 2 legs up to the top of the range, knowing the bulls are trapped, and they can probably make a scalp. Then we come back and test support down where the bears got trapped down here. Alright, that's going to be it for today's end of day review. Thanks everybody for watching, and I hope everyone has a great weekend.